An interesting thought experiment. Let's say you are staying on Mars and you have to invest on Earth. What percentage of your money would you invest only in India? The moment you start looking at things from a top down perspective, from a macro perspective, the first thought comes, why should I invest all my money into just one country? The reason why most of us invest all our money in India because we are familiar with these companies. We are familiar with HDFC, ICICI, Reliance, Infosys, TCS, Asian Paints. We have seen these companies. We use their goods and services. These companies are listed on our Bombay Stock Exchange and NSE and regulated by SEBI. So we feel very comfortable investing into these companies. But let's look at things from a global perspective, from a macro perspective. If you look at the entire world stock market index, India is less than 3% of the entire index. So if an investor is choosing to invest only in India, he's actually ignoring 97% of the market which is there outside. Let's look at some advantages of investing internationally. Emerging market, so India is part of the emerging market, and developed country, they basically have low correlation. And what do I mean by that? There are times when emerging market does well and developed market is not doing well. And there are times when developed market is doing well and emerging market is not doing well. Having a combination reduces risk in the overall portfolio. Just as an example, in last 20 years, from 2000 to 2010, Indian markets did very well, but US market gave very muted returns. In the last 10-11 years, the US market is doing exceedingly well, but Indian market has given muted returns. Now, if we combine both of them, the overall return profile and the risk profile becomes good. Now, one of the biggest advantage of investing internationally is also because when you put all your money into one country, we can have country-specific risk. There can be black swan events which can come in a particular country and it can disrupt the entire personal finance and financial planning. So investing internationally also reduces this kind of risk. From a taxation perspective, yes, we are investing into stocks internationally, but the taxation is debt taxation. That means anything which is less than 3 years, it gets added to your income. Anything which is above 3 years, you get 20% with indexation. So taxation of international funds is debt taxation. So to sum it up, your core portfolio has to be of domestic companies and your satellite portfolio can be of international stocks. This reduces the overall risk in your portfolio. If you're investing for the first time, start investing by US markets. US markets is approximately 50 to 60% of the entire stock market index. And I'm sure most of these companies, you use them on a daily basis. We are familiar with Apple, Amazon, Facebook, Zoom, Tesla, and so many other companies. If you're the first time investor, start with US markets. You can start in the form of SIPs and STPs and then slowly and gradually do lump sums over there. What percentage of money should be into international? It depends purely upon client's risk appetite. You can start with 5, 7, 10% and then gradually increase. So if you have to manage risk in a logical way, have a good portfolio of domestic stocks and international stocks. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.